Chapter 1. Definition of terms used in economics. Meaning of economics. 1. Economics is the science which treats of the principles and mechanism of commerce in its widest extent, or it may be called the science of exchanges. The word economics is derived from two Greek words oikos, which means property of all sorts and descriptions, including not only lands, houses, cattle, money, and sea, but also such property as banknotes, bills of exchange, the funds, shares in commercial companies, copyrights, and c, all of which can be bought and sold, and vuos, nomos, a law. Hence economics is the science which treats of the laws which govern the relations of exchangeable quantities. It may also be called the science of value. It is also sometimes called the science of wealth. On the meaning of wealth, or an economic quantity. 2. Ancient writers unanimously held that exchangeability is the sole essence and principle of wealth, that the word wealth means anything whatever which can be bought and sold, and consequently that whatever can be bought and sold, whatever its nature may be, is wealth. Thus Aristotle says, and we call wealth everything whose value can be measured by money. So Ulpian, one of the most eminent Roman jurists, says, for that is wealth, res, which can be bought and sold. The most recent economists are now agreed that this is the true definition of wealth. Thus Mill says, everything forms, therefore, a part of wealth which has a power of purchasing. This is the definition which we adopt on the three species of wealth, or economic quantities. 3. Wealth, then, being defined to be anything which can be bought and sold, or exchanged, whatever its nature may be, we have next to ascertain how many distinct kinds of things there are which can be bought and sold. 1. There are material things, such as lands, houses, cattle, money, jewelry, gold, silver, corn and innumerable other things of that nature. 2. The author of an ancient Greek dialogue called the Eryxias, or on wealth, which usually passes under the name of Aeschines Socraticus, adopting exchangeability as the criterion of wealth, showed that if a man can gain his living by giving instruction in science, that science is wealth to him for exactly the same reason that gold and silver are wealth. All modern economists, Smith, Say, Senior, Mill, agree that human abilities, skill, energy, and capacity are wealth. The exertion of human abilities, skill, and energy in any form which is paid for, is labor. And a person may sell his labor, or services, in many capacities, such as a plowman, an artisan, an advocate, a physician, an engineer, and c. And when a sum of money is paid for this labor, its value is measured in money as precisely as if it were a material chattel. Therefore labor is wealth. 3. It is laid down as a fundamental definition in Roman law that under the term wealth, pecunia, not only ready money but everything, both immovable and movable, both corporeal as well as rights, is included. In modern times an immense mass of property of the form of mere abstract rights has come into existence, such as bank notes, bills of exchange, the funds, shares in commercial companies, copyrights, patents, and many other kinds. All this kind of property can be bought and sold, and therefore its value is measured in money as precisely as that of any material chattel. For this reason it is called in Roman law res, bona, merx, and therefore in economics wealth. We have thus found three distinct orders of quantities which can be bought and sold, or whose value can be measured in money, and are consequently wealth, and there are no more. There is nothing whatever which can be bought and sold which is not of one of these three forms. Either it is a material thing, or it is some kind of labor or service, or it is an abstract right. And all commerce in its widest extent consists of the exchanges of these three orders of quantities. Commerce or economics consists of 6 distinct kinds of exchange. 4. As it has now been seen that there are 3, and only 3, distinct orders of wealth, or exchangeable quantities, it follows that there are 6 distinct kinds of exchange. These are: 1. The exchange of a material thing for a material thing such as so much corn, cattle, or land for so much gold. 2. The exchange of a material thing for so much labor or service, as when gold or silver money is paid as wages, salary, or fees. 3. The exchange of a material thing for a right, as when lands, houses, cattle, and c. are paid for in banknotes, bills of exchange, checks. 4. The exchange of labor for labor, as when persons agree to exchange one kind of labor or service for another kind of labor or service. 5. The exchange of labor for a right, as when wages are paid in banknotes. 6. The exchange of one right for another right, as when a banker buys a bill of exchange, which is a right, by giving in exchange for it a credit in his books, which is another right. These 6 kinds of exchange comprehend all commerce in its widest extent, and in all its forms and varieties. And they constitute the great science of economics, or the science which treats of the exchanges of property. On the meaning of the word property. 5. Having found that there are 3 distinct kinds of wealth, or exchangeable quantities, we have next to find a general term which will include them all. This general term we shall find in the word property, and when we understand the true meaning of the word property, it will throw a flood of light over the whole of economics. Most persons, when they speak or hear of property, think of some material things, such as lands, houses, cattle, money, and sea. But that is not the true meaning of property. The word property, in its true and original sense, does not mean a material thing, but the absolute right to use and dispose of something. In early Roman jurisprudence the word mancipium was used to mean the absolute ownership of anything as well as the thing itself, because it was supposed to be acquired by the strong hand, and if not kept with a firm grasp, might probably be lost again. Afterwards the ownership of things was held to reside in the family, or domus, but the head of the house, dominus, alone exercised all rights over them. Hence this right was called dominium. No other member of the family could have any exclusive right. Dominium, then, became the term in Roman law for the absolute ownership of anything. Afterwards, in the time of the early emperors, the excessive rigor of the patria potestas was relaxed, and in some cases individual members of the family were allowed to have exclusive rights to things, and this right was called proprietors, because it was restricted to the individual, and excluded everyone else. Dominium idist proprietors, says Neratius, a jurist of the age of Trajan and Hadrian. Proprietors, therefore, in Roman law meant absolute ownership, and not the things themselves. The word property was always used in this sense exclusively by early English writers. Thus grand old Wycliffe says, "They will have property of ghostly goods where no property may be, and leave property in worldly goods where Christian men enow have property." So Bacon invariably uses the word property to mean a right, and not a thing. He says one of the uses of the law is to dispose of the property of their goods and chattels. He explains the various methods by which property in goods and chattels may be acquired. Property, then, in its true sense means solely a right, interest, or ownership, and, consequently, to call material goods property is as absurd as to call them right, interest, ownership. It is quite a modern corruption of the word. 6. But though property is a right, all rights are not property. There is an essential distinction between the right of possession merely and the right of property. If I lend my friend a book or a horse, he has the right of possession in these things so long as I lend them to him, but he has not the right of property in them. The right of property means the absolute right to use a thing in any way we please, to make a profit by it, or to sell or dispose of it in any way we please. Thus when we speak of landed property, house property, funded property, literary property, we mean rights to land, rights to houses, rights to payments from the nation, rights to the profits from literary works. 7. Many words which are usually supposed to mean things in reality mean rights. Thus an annuity is the right to demand a series of payments, and not the sums actually paid. The funds are rights to demand a series of payments from the state, and not the money actually paid. Tithes are the right to demand a certain portion of the produce of the earth, and not the produce itself. Rent is the right to demand compensation for the use of lands, houses, and sea, and not the money actually paid. A debt is the right to demand a sum of money from a person and not the money due, and so on in a multitude of other cases. On corporeal or material, immaterial, and incorporeal property. 8. Property being, then, clearly understood to mean a right, there are 3 distinct kinds of property. I. Material or corporeal property. There may be property in some material physical substance, which is already in existence, and has come into possession of the proprietor, like lands, houses, money, and sea. 2. Immaterial property. A man has the right to the use of his own faculties, abilities, energy, and to the profits to be reaped by them. This is called immaterial property by the French economist J.B. Say. 3. Incorporeal property. We may have a right wholly severed from any specific corpus, or matter in possession. It may not even be in existence at the present time. Thus those who possess lands, fruit trees, cattle, and sea, have the property in their future produce. Though the produce itself will only come into existence at a future time, the property or right to it when it does come into existence is present, and may be bought and sold like any material chattel. Or the thing may be in existence, but it may be someone else's property at the present time, and only come into our possession at some future time. Thus we may have the right to demand a sum of money from some person at some future time. That sum of money may, no doubt, be in existence, but it is not in our possession. It may not even be in the possession of the person who is bound to pay it. It may pass through any number of hands before it is paid to us. But yet our right to demand it is present and existing, and we may sell and dispose of it exactly as if it were a material chattel. Hence it is property, but it is called incorporeal property in Roman and English law, because it is a mere abstract right, wholly severed from any specific substance. Hence it is seen that the word wealth, or an economic quantity, means an exchangeable right, and that all exchanges are of rights against rights. When we exchange so much corn for so much gold, we exchange the right to so much corn for the right to so much gold, and so on for all other species of exchanges. On the application of the positive and negative signs of property. 9. Economic quantities, or economic rights, are, then, of three species. 1. Property in some material substance which has already been acquired. 2. Property in ourselves, our talents, and abilities. 3. Property in something which is only to be acquired at some future time. Now, we can absolutely part with and divest ourselves of the property in material substances, or the first order of economic quantities. In exchange for some reward we can transfer to someone else the right to make use of our intellectual qualities or services on a special occasion. But though we may receive a reward for exercising our faculties in some person's service, we do not part with them. We may sell our knowledge, but it is not gone away from us. Like a candle which communicates light to others, it does not diminish our own light. A man may sell his instruction, but it does not diminish his own store. The third species of economic quantities, or rights, are invisible and intangible, like the second species, but they are transferable, like the first, and when we exchange or sell them, we divest ourselves absolutely of our property in them, as we do of the first species. Now, we observe that the two species of property of which we can absolutely divest ourselves are inverse to each other. Property, like Janus, has two faces, placed back to back. It regards the past and the future, and is therefore of opposite qualities. Now, in all physical and mathematical sciences it is invariably the custom to denote similar quantities but of opposite qualities by opposite signs. Hence, as a matter of simple convenience, and following the usual custom in physical science, if we denote one of these kinds of property as positive, we may, as a distinguishing mark, denote the other as negative. Thus if we denote property in a product which has been acquired as positive, it is perfectly consonant with the universal practice in physical philosophy to denote property in a product that is to be acquired as negative. Now, property in a thing which has been acquired is corporeal property, and property in a thing which is to be acquired is incorporeal property. Hence, if we denote corporeal property by the positive sign, it is strictly in accordance with all physical philosophy to denote incorporeal property by the negative sign. And as in all mathematical and physical sciences the whole science comprehends both positive and negative quantities, so the whole science of economics comprehends both positive and negative economic quantities, both corporeal property and incorporeal property. On the distinction between the jus in rem or in re and the jus ad rem, or the jus in personam. 10. We must now notice another division of property of great importance. Property is of two kinds. 1. Property in a specific chattel, termed a jus in rem or in re in Roman law, without being related to anyone else, called also dominium. When a person has such a sole and exclusive right in anything, he may sell or transfer it to anyone else in any way he pleases. Money is subject to this sort of property, and hence a man may freely sell and transfer his own money, or any other chattel. 2. Property held in contract, or obligation, called in Roman law jus ad rem or jus in personam, where a person has a right, but not to any specific thing, but only against a person to pay or do something. But property held in contract is of two kinds. A. Where each party has rights to receive and duties to perform, such as the nexus, or obligation, between lord and vassal in feudal law, or that between master and servant at the present time. This is termed a bilateral or synallagmatic contract. B. Where there is only a right to receive on one side and a duty to perform on the other, such as the relation between creditor and debtor or landlord and tenant in modern times. This is called a unilateral contract. Formerly it was held universally that wherever property was held in contract of either sort, neither party could substitute another person for himself, at his own will and pleasure, and without the consent of the other party to the contract. This rule must manifestly hold good in all bilateral contracts, because as each side has a duty to perform, of course the person who has that duty to perform cannot substitute anyone else to perform it without the consent of the other party. Thus, so long as the feudal law retained its pristine rigor, neither the lord nor the vassal could substitute anyone else for himself without the consent of the other party. So in the case of master and servant at the present day, a master cannot transfer his household to anyone else without their own consent, as if they were cattle or slaves. Neither can a servant substitute anyone else in his place without his master's consent. The same principle originally held good when the contract was unilateral, as in the case of creditor and debtor. The creditor could not transfer his right of action against the debtor, because the debtor never agreed to pay anyone except his own creditor. It is a rule of law and common sense that no man can contract for another without his consent, unless, therefore, the debtor had agreed with the creditor that he might transfer his right. The creditor had no power to guarantee his transferee that the debtor would pay him. Accordingly, both in Roman and English law, for a long period, the creditor could not transfer his right of action against his debtor without the debtor's consent, so as to enable the transferee to sue the original debtor. But nevertheless, though this may be true in theory, the party in an obligarian of this form who has the right to demand soon begins to insist upon the power of transferring this right like any other property. And there is a very good reason for this, for in the obligation or contract of debt there is manifestly a strong distinction between the two parties, the creditor and the debtor. The debtor cannot substitute another debtor for himself, because the creditor may not have the means of knowing the solvency of the substituted debtor. Therefore, by the very nature of things, the consent of the creditor is indispensable to the substitution of a new debtor, as, for instance, no one can compel his creditor to take payment of a debt in the notes of a country banker. But the case of the debtor is different. If a person really owes a debt and has the means of paying it, it cannot make the slightest difference to him whether he pays it to A or to B, provided he can get a discharge for it, and is not called upon to pay it twice over. Hence, while the assignment of a new debtor might seriously prejudice the creditor, the assignment of a new creditor can be no real prejudice to the debtor. In A.D. 224 the Emperor Alexander Severus enacted that a creditor might sell his right of action without the knowledge and without the consent of the debtor, and ever since then all actions of every sort have been as freely saleable as any material chattel on the continent. By a recent act this principle has been adopted in England, and on November 1, 1875, the sale of debts became absolutely free in England on property as goods and chattels. 11. We have seen that property, including abstract rights of all sorts, is included under the titles of pecunia, res, bona, merx, in Roman law, because it can all be bought and sold. For the same reason abstract rights are included under the terms goods, goods and chattels, chattels, vendible commodities, in English law. Thus Blackstone says, for it is to be understood that in our law chattels, or goods and chattels, is a term used to express any property which, having regard either to subject matter or the quantity of interest therein, is not freehold. Property or chattels personal may be either in possession or else in action. Property in action is where a man has not the enjoyment, either actual or constructive, of the thing in question, but merely or right to recover it by a suit or action at law. Thus all such property as debts, banknotes, bills of exchange, the funds, shares in commercial companies, copyrights, and c. are goods and chattels in English law, just as much as any material chattels. Definition of value. 12. If at any time any economic quantity A can be exchanged for any economic quantity B, then the quantity A is termed the value of B in terms of A, and B is the value of A in terms of B. Suppose that at any time 1 ounce of gold will exchange for 15 ounces of silver, then it is said that 1 ounce of gold is of the value of 15 ounces of silver, which is this equation. I.Os. Gold equals 15 ounces silver, as Aristotle says. Now, the term value is used in reference to external goods, and it is said in Roman law, the value of a thing is what it can be sold for. We may therefore say the value of any economic quantity is any other economic quantity for which it can be exchanged. Now, as any economic quantity can be exchanged for any other, any economic quantity may have value in terms of any of the others, and an economic quantity has as many values as quantities it can be exchanged for. And if it can be exchanged for nothing it has no value. On money and credit. 13. In the primitive ages of the world there was no such thing as money. Traders exchanged their products directly with one another. This exchange of products is termed barter. The inconveniences of this mode of trading are palpable. It would give rise to endless disputes to determine how much of one product should be given for another. Some ingenious person would then discover that it would greatly facilitate traffic if the things to be exchanged were referred to some common measure. In the Iliad and Odyssey there are several passages in which things are estimated as being worth so many oxen. This does not imply, however, that these oxen served the purpose of money. The state of barter continued, as it is quite common at the present day to exchange goods according to their value in money, without the use of actual money. The necessity for money arises from a different cause. As long as the things exchanged were equal in value there would be no need for money. But it would often happen that when one person required some product or service from his neighbor, that neighbor would not require an equal amount of product or service from him at the same time, or perhaps even none at all. If, then, a transaction took place with such an unequal result, there would remain a certain amount or difference of product or service due from the one to the other, and this would constitute a debt, that is, a right, or property, would be created in the person of the creditor to demand this balance of product or service at some future time, and at the same time a duty is created in the person of the debtor to pay the product, or render the service, when required. Among all persons who exchange this result must inevitably happen. Persons want something from others when those others want nothing from them, and it is easy to imagine the inconveniences that would arise if persons never could get anything they wanted, unless the person who could supply these things wanted something in return at the same time. In process of time all nations hit upon this plan. They fixed on some material substance, which they agreed to make always exchangeable among themselves, to represent the amount of debt. Suppose a wine dealer wants a quantity of bread from a baker, but the baker wants only 1/2 the equivalent quantity of wine from the wine dealer, or perhaps even none at all. The wine dealer takes the bread from the baker and gives him in exchange as much wine as he wants, and makes up the balance by giving an amount of this generally exchangeable merchandise. Or if he wants no wine at all, the wine dealer gives him the full value or equivalent of the bread in this merchandise. The baker perhaps wants shoes and meat, but not wine. Having received this merchandise from the wine dealer, he goes to the shoemaker or butcher, and obtains the equivalent of the product he sold to the wine dealer in the form of shoes or meat. Thus is seen the fundamental nature of money, as this generally exchangeable merchandise is called. Its special and particular purpose is to represent the debts that arise from unequal exchanges among men, and to enable persons to obtain the equivalent of the service they have done to one person from someone else. Thus the true nature of money is to be a right or title to demand something from someone else. Many writers have seen that this is the true nature of money. Thus Aristotle says that money is our security that we may get something when we do want it, If we want nothing at present. Board, one of the most eminent of the first school of economists, says, this coined money in circulation is nothing but effective titles on the general mass of useful and agreeable enjoyments. It is a kind of bill of exchange or order payable at the will of the bearer. Sir Smith says, a guinea may be considered as a bill for a certain quantity of necessaries and conveniences upon all the tradesmen in the neighbourhood. Henry Thornton, the eminent banker, says, money of every kind is an order for goods. So Mill says, the pounds or shillings which a person receives weekly or yearly are not what constitute his income, they are a sort of ticket or order which he can present for payment at any shop he pleases. Thus all these writers, and many more might be cited if our limits allowed us, have seen the true nature of money. Different nations have used different substances to represent this universal want. Silver, copper skewers, carved pebbles, shells, blocks of tea, salt, dates, dried cod, sugar, tobacco, nails, powder and shot, logwood, belts of wampum, and many other things have been used for this purpose. But there is no substance which has so many advantages as a metal, and of metals gold and silver are superior to any others, as they can be kept for any length of time without deterioration. 14. Now when persons take a piece of money in exchange for products or services, they can neither eat it, nor drink it, nor clothe themselves with it. They can make no direct use of it. They only take it because they believe they can exchange it away again for other things which they do require. It is therefore what is called credit, as Edmund Burke says of gold and silver, the two great recognized species that represent the lasting conventional credit of mankind. Credit is therefore the right or property of demanding something from someone else. It is the right to a future payment. It is the name of a certain species of right or property. Gold and silver money may be called metallic credit. 15. So long as nations continue in a low state of civilization, all this credit, or money, is of some material substance, but when they advance in civilization they use credit of another form. To revert to the case from which we showed how the necessity for money originated, that of an unequal exchange, suppose that the debtor, instead of the general merchandise called money, gave the creditor a simple promise to pay the balance of product or services when required. Then the creditor has only the right to demand an equivalent in future from his own debtor. Now, it is this abstract right to demand something which in law, commerce, and economics is termed credit, but it is only a right against a particular person. Suppose, for instance, that a person holds a tea merchant's promise to pay £5 of tea. The creditor may sell or transfer that right to anyone else. Suppose he happened to want bread and the baker happened to want tea, the creditor might sell the right to demand tea in exchange for so much bread. Now, that right is only to demand a particular thing, and only from a particular person, and that person may die or become insolvent, and may not be able to fulfill his promise. Hence the value of the promise is particular and precarious. But if the tea merchant can fulfill his promise, that promise is of the value of the tea. The tea is the value of the promise, and to anyone who wants tea the promise is of exactly the same value as so much money. So if anyone wants anything, an order for that thing is of the same value to him as money with regard to that particular thing. Such an order, or promise, of course has only one value, whereas money has a multitude of values. And if the person who has given the promise cannot fulfill it, the promise has lost its value. Such an order has therefore only particular and precarious value, but money has general and permanent value. Such an order, or promise, which is credit, although of an inferior and lower form, is yet of the same general nature as money. And because such orders or promises can be bought and sold like any material chattels, they are called pecunia, res, bona, and mercs in Roman law, and goods and chattels in English law. It thus appears that it is quite possible to carry on the exchanges of society without material money. During the late Civil War in America, gold and silver money entirely disappeared from circulation, and private tickets of the nature just described took its place. Instead of money, people had their pockets filled with bread tickets, milk tickets, railroad tickets, and these orders, or promises, when recorded on paper, are called paper credit. In its simplest form it would have the particular service or product it was intended to command stated on the face of it. but it is found more generally convenient to make paper credit a promise to pay metallic money. But from what has been said, it is clear that credit is the right to demand something from a particular person, and that money is a general right to demand anything from the commercial community. Hence it is clear that money and credit are homogeneous quantities, and that money is the highest and most general form of credit. On sale or circulation. 16. When commodities are exchanged directly with one another, it is called barter. When commodities are exchanged for money, that money is only taken in order that it may be exchanged away again for something else. Hence Say aptly said that when money is used, the transaction is half an exchange. It is also called a sale or circulation. Sale, or circulation, always means a transaction in which one of the quantities, or 12 sometimes both the quantities, exchanged is money or credit. An exchange is always an interchange of things of a like nature, as products for products, or money or credit for money or credit. Thus we speak of the change or exchange of a banknote or check for money, or of exchanging a picture for a statue, or one book for another. When a person gives money or credit for a commodity, he is said to buy it, and the one who gives the commodity to sell it. Thus we buy a horse or a house with money. Formerly an officer bought a commission in the army, but he exchanged from one regiment to another. In Hamlet Laertes says, "Exchange forgiveness with me, noble Hamlet." The sum total of transactions in which money or credit is used is properly termed the circulation. On the meaning of circulating medium. 17. The term circulating medium does not occur in Smith. It came into use in the last decade of the last century, but there is no difficulty as to its meaning. It has just been explained that transactions in which money and credit are used are called sales or circulation. Now the circulating medium is the medium by which sales or circulation are effected, and, from what has just been said, the circulating medium is simply money and credit in all its forms and varieties. On the meaning of currency. 18. There is, however, somewhat more difficulty about the meaning of the word currency, which is always used as synonymous with circulating medium. It is originally a term of mercantile and constitutional law. The following is the meaning of the words current and currency in English law. It is a general rule of English law that a person cannot transmit to another any better title to a thing than he possesses himself. It is also a rule of law, that if a person has lost a thing, or has it stolen from him, he does not thereby lose his right or property in it. Consequently he can not only recover it from the finder or thief himself, but even if the finder or thief has sold it to someone else, who has given a full price for it, and buys it quite honestly and without knowing that it was not the property of the seller. The only exception to this was, if the finder or thief sold the goods in market avert. If the goods were bought in market avert, the buyer might retain them against the true owner even if they were stolen. But to this rule of English law money was always an exception. If the true owner of money finds it in the hands of the thief, he can recover it, but if the thief or finder has purchased goods in a shop with it, and the shopkeeper takes it honestly in the way of business, and without knowing that it has been stolen, he may retain it against the true owner from whom it has been stolen, even if he can identify it. That is, the property in it passes by delivery. It is this peculiarity in the law affecting the property in money which passes by delivery which is denoted by the word currency. And when the representatives and substitutes for money, such as banknotes, bills of exchange, checks, and other securities for money, came into use, the lex mercatoria, or custom of merchants, applied the same doctrine or principle of currency to them. They were treated like money insofar as this, that the property in them passed like the property in money. Thus, if they were stolen, the true owner might recover them if he found them in the possession of the thief, but if the finder or thief had passed them away for value in the usual course of business to an innocent holder, that innocent holder acquired the property in them, and might retain them against the true owner, and enforce payment of them from all the parties liable. Thus bills of exchange, banknotes, checks, and all other securities for money were assimilated to money in this important respect, that, even though stolen, when they had once been passed away in currency, the property in them belonged to the person who had innocently purchased them, and, as Lord Mansfield said, no action would lie for them after they had once been paid away in currency. It is thus seen that in strict law the word currency can only be applied to those rights which are recorded on some material. An abstract right cannot be lost, mislaid, stolen, and passed away in commerce. For a right to be currency in strict law it must be recorded on some material, so as to be capable of being carried in the hand, or put away in a drawer, or dropped in the street, and stolen from the drawer, or from a man's pocket, and carried off by the finder or thief, and sold like a piece of goods. So far, then, as regards law, there is no difficulty, the meaning of the word is perfectly plain. But if the word currency is used to denote a certain class of economic quantities, synonymously with circulating medium, a difficulty arises, because there is an immense mass of credit which has produced exchanges, and is therefore circulating medium, which is not recorded on any material substance, so that it can be lost or stolen, and passed away by manual delivery. Thus the gigantic mass of bank credits and book debts of traders have effected a sale or circulation of commodities, and therefore they are all circulating medium, but they are not currency in a legal sense, because they cannot be mislaid, or lost, or stolen, and passed away by manual delivery. But though these book credits are not currency in point of law, they must be included in that word when used as a scientific term in economics, synonymous with circulating medium, because these rights of action are exactly the same in their nature and effects, whether they are recorded on paper or not. This truth was well expressed by the Marquis of Titchfield in the House of Commons, in speaking of various forms of credit used as substitutes for money, when it was considered to how great an extent these contrivances had been practiced in the various modes of verbal, book, and circulating credits. It was easy to see that the country had received a great addition to its currency. This addition to the currency would of course have the same effect as if gold had been increased from the mines. 19. Adopting, then, this definition, we may enumerate the different species of currency, or circulating medium, as follows. 1. Coined money, gold, silver, and copper. 2. The paper currency, bills and notes in all their varieties. 3. Simple debts of all kinds not recorded on circulating paper, such as credits in bankers' books, called deposits, book debts of traders, and private debts between individuals. All these denote that a transfer has taken place, and are a title to future payment. It is true that some species are more eligible and secure than others, but that does not alter their nature. They all represent the same fundamental idea, debt. Hence it follows that the amount of currency, or circulating medium, in any country, is the total of all the debts due to every individual in it, that is, all the money and credit in it, on price, discount, and interest. 20. When any economic quantity is exchanged for another, each is termed the value of the other. But when one of the quantities exchanged is money or credit, the sum of money or credit receives a peculiar name. It is termed price. Price is therefore always the value of anything expressed in money or credit. Now, as the value of money or credit is the greater as more of any commodity can be obtained for it, or if the quantity of the commodity be taken as fixed, the value of money is greater as less money is given for the commodity, it follows that the value of money varies inversely as price. Debts or credits are commodities, and, like other commodities, they must be divided into certain units for the convenience of sale. Coals are sold by the ton, other things by the pound, others by the ounce. The unit of debt is the right to demand 100 litres, to be paid 1 year hence. The sum of money or credit paid to buy this unit is its price, and the smaller the price given the greater is the value of money. But in the commerce of debts it is not usual to estimate the value of money by the price of the debt. The price of the debt is of course less than the amount of it, and the difference between the price of the debt and its amount is the profit made by buying it. This profit is called discount. And it is clear that, as the price of the debt decreases, or increases, their discount or profit increases or decreases. In the commerce of debts it is always usual to estimate the value of money by the discount or profit it yields. Hence, in this latter case the value of money varies directly as discount. Hence it must be observed that in commerce the expression value of money has two meanings, according as it is applied to buying commodities or debts. In the former case it means the quantity of the commodity bought, in the latter it means the profit made by buying the debt, and accordingly we have this rule. The value of money varies inversely as price, and directly as discount. To discount a bill at 5%, means to give a price for the debt in the proportion of 951. For every 100 liters of its amount, payable 1 year hence. When a person advances money to another, and agrees to defer receiving the profit till the end of the period, the profit is termed interest. If he lends 100 liters for a year at 5% interest, he pays down 100 liters, and buys the right to demand 1051 at the end of the year, and the 51 is the interest. When the profit is retained at the time of the advance, it is termed discount. In this method the lender advances 951, and buys the right to demand 100 liters at the end of the year. This is the method always adopted by bankers in making advances. It is clear that discount is more profitable than interest, because in the former case the lender gains 51 on the advance of 951, in the latter case on the advance of 1 noel: and besides that he has the profit to trade with at once, instead of waiting till the end of the year for it. The rate of interest or discount is the amount of interest or discount made in some given time, as a year, on production and consumption, or supply and demand. 21. The terms production and consumption were invented by the first school of economists, and must always be taken together. Production comes from the Latin word producere, which means to draw forth and place on a given spot, or to offer for sale. Thus Terence says, "Paritium sprum silico produce it, vend, hoping for a good price offers her there for sale, sells her." To produce, then, in economics means to bring any commodity into the market and offer it for sale. The producer, in the language of commerce, is the person who offers anything for sale. The first school of economists restricted the term wealth to the material products of the earth, and they expressly defined production to mean the obtaining the raw produce from the earth and bringing it into the market for sale. Consumption, consummation, was used by the same school of economists to mean finally purchasing a commodity, and taking it out of the market for use and enjoyment. It is derived from the French word consommer, which comes from the Latin consumere, to complete or finish. Consummation meant the completion of an exchange. When one person, for instance, exchanged a picture for a statue with another person, each obtained a satisfaction, and this the first school of economists called a complete exchange. Hence the consumer was simply the purchaser or the customer. In the language of commerce, the consumer means the buyer. Thus the expression production and consumption means simply exchange. So long as the term wealth was restricted to mean the material products of the earth only, there was no awkwardness in the terms production and consumption. But when the second school of economists treated labor as a marketable commodity, or wealth, and when the third school of economists treat rights as marketable commodities or wealth, very considerable awkwardness arises. For even though it is expressly explained that production means nothing but offering for sale, and that consumption means nothing but buying or purchasing, it is very awkward to speak of the production and consumption of labor and rights. Under these circumstances it is better to resort to words of wider import, and these we have in the words supply and demand. Production, or the quantity produced and offered for sale, is the supply. The quantity bought or consumed is the demand. It is quite usual to speak of the supply and demand of labor, or the supply and demand of bills of exchange or debts. And the terms supply and demand together constitute exchange. Hence while the terms production and consumption were never intended to apply to anything but the material products of the earth, the terms supply and demand apply to the exchanges of all the three kinds of exchangeable quantities on the three kinds of production. 22. Production being explained to mean placing a commodity in the market and offering it for sale. There are various kinds of operations which are necessary to and are included in the term production. 1. Some persons obtain the raw produce from the earth, such as tillers of the ground, miners, hunters, fishers, and sea, and bring it into commerce. These are termed agricultural producers. 2. Other persons transform this raw produce by an infinity of processes, and render it fit for human use. These are termed manufacturing producers. 3. Other persons transport the commodity from places where it is cheap and less required to other places where it is dear and more required. These are termed commercial producers. All these various kinds of producers may be necessary to place any required commodity in the market where it is ultimately offered for consumption or final purchase, on cost of production. 23. Production being the placing any commodity in the market and offering it for sale. The cost of production is the sum actually expended in placing it in the market where it is offered for sale, on profit. 24. The cost of production being the sum actually expended in placing any commodity in the market where it is offered for sale, the sum for which it is sold is its value, and the difference between the cost of production and the value is termed profit. The value may exceed or fall short of the cost of production. When the value exceeds the cost of production, the profit is positive, and is termed a gain. When it falls short of the cost of production, the profit is negative, and is termed a loss. The rate of profit is the amount of profit made in some given time, as a year, on productive and unproductive labor. 25. The term productive labor was used by the first school of economists to denote labor which produced a profit after defraying the cost of production. And to use a thing productively meant to use it so as to produce a profit. Unproductive labor was labor which produced no profit after defraying the cost of production. On rent and hire. 26. Exchanges in commerce are of two sorts: one where the absolute property in the thing is purchased, or the right to it forever; the other where only the right to use it for a limited period is purchased. When the right or property in the thing forever is purchased, the sum given is called its price. When the right only to use it for a limited period is bought, the sum given is called rent or hire. In general, the word rent is used when the sum given is made in a series of payments for continuous use. The word hire is generally used when the sum is given in a single payment. Thus a person may purchase the use of a farm, or a house, or a die, or a copyright, or a patent, or a telegraph wire, or a frame, for a certain time and make a series of payments for their use. These payments are always called rent, or rather the right to demand them is the rent. Formerly the right to demand a series of payments for the loan of money was also called rent. This name is not usually applied in English now to such payments, but it continues in use in French. Thus the French funds are called rents, and a fund holder is called a rentier. When the sum is given in a single payment it is usually called hire. Thus a person hires a horse for the day, or hires a cab, or a porter. There is, however, no absolute rule on the subject. If horses and carriages were hired by the year, the sum paid would be called hire and not rent, and the sum paid for lands and houses is called rent, even though there be only one payment made. On capital. 27. Any economic quantity whatever may be used in two different ways. 1. It may be used for personal enjoyment. 2. It may be used for the purpose of profit, or it may be traded with. When any economic quantity is traded with, or used so as to produce a profit, or, in the language of economics, used productively, it is termed capital. Thus Senior says, economists are agreed that whatever gives a profit is properly termed capital. And Buffon says, wherever there is a revenue you perceive capital. The definition of capital is, therefore capital is any economic quantity used for the purpose of profit. 1. Any material thing may be used as capital. Money spent upon household requirements or in gratifying personal tastes is not capital. But if it is lent out at interest, or expended in buying goods with the intention of selling them again with a profit, then such money is used as capital, and the goods are also capital, because they are intended to be sold with a profit. So land let out for the purpose of profit is capital. 2. All modern economists, Smith, Say, Senior, Mill, class personal abilities, skill, energy, and character as capital, because they may be used so as to produce a profit as well as any material chattel. If a man digs in his garden for his own amusement, or if he sings, or acts, or gives lectures to his friends gratuitously, such labor is not capital. But if he sells his labor in any capacity for money, such as a plowman, an artisan, a physician, an engineer, an advocate, or in any other way, such labor is capital. Any exertion of human abilities in any way which is paid for as labor, and a person can make an income by the exertion of his personal abilities, which is measurable and taxable, just as if he made an income by selling goods. Such capital is called by J.B. say immaterial capital. But a man may use his personal character, skill, energy, and probity for the purpose of profit in another way besides the direct exchange of his labor for money. He may use them for the purpose of buying goods, materials, and by giving his promise to pay at a future time, instead of actual payment in money, with the intention of selling those goods with a profit. In popular language, this purchasing power of character is called credit. And a trader makes a profit by trading with his credit precisely in the same way as he traded with money. A merchant's general credit, or purchasing power, does not come into economics until he actually makes some purchase with it, and then he gives his promise to pay for the goods, instead of actual money. It is this promise to pay, this debt or right to demand payment, which is the economic quantity called credit, and it may be bought and sold like any material chattel. 3. So any other economic quantity or right may be used as capital. If an author writes a successful work, the copyright of it is capital to him, and if a publisher buys the copyright it is capital to him. There is a class of traders whose business it is to buy and sell rights of various kinds. The funds, obligations, and shares in commercial companies. They keep a stock of this property on hand, just as other traders keep a stock of material goods. It is, therefore, to be observed that there is no such thing as absolute capital. It entirely depends upon the way in which a thing is used, whether it is capital or not. As Mill says, whether a thing is capital or not does not depend upon its own nature, but upon the mind of its owner. A piece of money may be used as capital in one exchange, and not as capital in the next exchange, if in the first it is meant to be replaced with a profit, and in the next it is used for personal enjoyment. Capital may increase in two ways. 28. Capital may increase in two distinct ways. 1. By actual increase of quantity, flocks and herds, and all fruits of the earth, increase by adding to their number or quantity. 2. By exchange, that is, by exchanging something which has a low value in a place for something which has a higher value, that is, by commerce. Money becomes capital, or produces a profit. By the second of these methods, it is exchanged for some goods or labor, the produce of which may be sold or exchanged again for a greater sum than they cost. Credit is used as capital precisely in the same way, namely, by buying goods which may sell for more than they cost, so that, after discharging the debt incurred by their purchase, there may be a profit over. Suppose a merchant buys goods with 100 liters in money, and sells the goods for 1,251, then he is better off at the end of the operation by 251 than at the beginning. Suppose that he has no money and no credit, he can buy no goods and make no profit. Suppose, however, that the owner of the goods, trusting to his character, probity, and skill, sells him the goods in exchange for his promise to pay at a future time. As the payment is deferred, and there is some risk, the merchant must pay a higher price in credit than in money. Suppose he has to pay 105 liters in credit. Then, as before, he sells the goods for 1,251. He has to discharge the debt of 105 liters. And after paying that he was a profit of 201 over. That is, he is 20 liters better off at the end of the operation than he was at the beginning now. By the cash operation he is better off by 251, and by the credit operation he is better off by 2 than he was at the beginning. It is true he does not make so great a profit by credit as by cash, but yet he has made a profit by his credit which he could not have made without it. Hence by the very definition his credit has been capital to him, and has produced exactly the same circulation of commodities that cash would have done. Hence we see that credit is productive capital in exactly the same way and in the same sense that money is on fixed and floating capital. 29. It is, then, distinctly to be understood that there is no such thing as absolute capital. It depends entirely upon the intention and method of use whether a thing is capital or not. But capital itself may be used in two different ways so as to produce a profit. 1. The capitalist may retain it in his own possession, and make a continuous series of profits by its use. In this case it is called fixed capital. 2. The capitalist may part with it entirely, and replace the entire value of the capital with the profit in one operation. In this case it is called floating capital. It is clearly to be understood that it is according to the intention of the person who produces an article, and the purpose for which it is used, that it receives either of these names. The same article may be floating capital in the hands of one man, and fixed capital in the hands of the next possessor, if the first produces it for the purpose of selling it, and the second purchases it for the purpose of deriving an income from its use. This distinction is often overlooked, and the term fixed capital is applied to articles of a certain nature, and floating capital to articles of another nature. Thus Smith enumerates 4 species of fixed capital: 1. Useful machines and instruments of trade; 2. Buildings used in all sorts of trades; 3. Improvements of land; 4. The acquired and useful abilities of the members of the society. This enumeration is very imperfect, because it omits that stupendous mass of incorporeal property which has so enormously increased in recent times. Thus if a man invests money in the funds, or in shares in a commercial company, or in purchasing the goodwill of a business, or the practice of a profession, or if a publisher buys the copyright of a work, all these are fixed capital to him. Smith also enumerates 4 species of floating capital. 1. The money by means of which the other 3 are circulated and distributed to their proper consumers. 2. The stock of provisions in the hands of various dealers. 3. The materials in the hands of different work people to be made up. 4. The same materials when made up into finished products and ready for sale. Under the term money Smith includes banknotes, bills of exchange, and c, which are credit, and therefore he includes credit under the term capital. Now, it is to be observed that houses and lands are by no means invariably fixed capital. It is quite common for speculators to buy up land or to build houses for the express purpose of selling them again. In the hands of these speculators the lands and houses are floating capital. There are many manufactories of machinery; the machines are made for the purpose of being sold. In the hands of such persons these machines are floating capital. In the hands of the persons who retain these machines in their own possession, and use them in their business, they are fixed capital. To a person who buys the funds or shares in a commercial company as an investment to produce him an income, they are fixed capital. But there is a class of traders who buy and sell these kinds of property like the goods in a shop. To these persons they are floating capital. On payment and satisfaction. 30. The word payment in law and commerce means anything whatever which is taken in exchange for something else. It comes from the Italian pagare, from the Latin pacere, to appease, and it means anything whatever which appeases the claim or demand of any other person. Because when any person has delivered or done anything for another, unless it is meant to be a donation, he has a claim for an equivalent, but at the same time he has the right to consider anything he pleases as an equivalent. Thus, when 2 persons exchange material products, each is payment for the other, because each satisfies the claim of the other for an equivalent. It is sometimes supposed that when money is given in exchange for goods, it is only the money which is the payment. But this is a great error. The money is the payment for the goods, but the goods are equally payment for the money. So when money is paid in wages, the money is the payment for the work, and the work is the payment for the money. So when a merchant takes a bill at 3 months in exchange for goods, the bill is payment for the goods. It appeases the claim of the merchant. He has got what he voluntarily agreed to take in exchange for the goods. When the bill becomes due the debtor has to pay the bill, or appease the claim which the owner of the bill has for the money. But it by no means follows that payment is the final closing of the transaction. The only legal word which denotes the final closing of the transaction is satisfaction. If a bill is taken in exchange for goods, it is payment, but it is not satisfaction until the bill itself is paid. And economists go further. They say that money itself is only a higher order of bill, and that though giving money is payment, it is not satisfaction until the money is exchanged away for something that is desired. Thus, though a shoemaker may be paid when he has got money for his shoes, yet he has not got a satisfaction until he has got bread, or meat, or wine, or anything else which he desires. On the meaning of persona and res in Roman law. 31. It will be very useful to explain the meaning of the words persona and res in Roman law. Persona means any single person or any society of persons who can enjoy and exercise rights. Thus in a partnership each member is a persona. but also the partnership is a persona, quite distinct from its individual members. The consequence is that each member of the society can have dealings with, and buy and sell with, the society, just as with any other individual. Every joint stock company is a persona, and when the individual members pay their money as capital to the company, the property in it is gone from them and vests in the company, and what they receive in return for it is a right to participate in the future profits of the company in the proportion in which they have contributed capital. An important example of this nature is the state. The state is a persona quite independent of its individual citizens. Private individuals can lend money to the state, and receive in return the right to receive a series of payments. These rights are called the funds, and this is the meaning of the parson of a parish. He is the persona who enjoys the right to certain compensation or reward for his services, and this right to these ecclesiastical dues is called a benefice. And as a persona is anybody, single or corporate, which can enjoy a right, so res is anything whatever which can be the subject of a right. Thus not only material things are termed res, but also human actions or services. If I hire a man to do some service for me, I have the right to demand that labor or service from him, and therefore it is a res. So also if I have the right to demand a sum of money from some person in consequence of having lent him money or sold him goods on credit, that right is termed a res, and so is every other right to future payment or profit. It is the exchange of these different kinds of rights which constitute commerce in its widest extent, or the science of economics, which is the subject matter of this work.